Jim, it's great to have you. Man, I mean, the whole sector just is whipsawed by these GLP-1s. Can they sort of escape that tractor beam?
Yeah. Thanks for having me on, guys. I think, what you need to look at across the staples space is everyone has gotten beat up by these GLP-1 drugs. And so you have a pretty attractively positioned buying opportunity for companies that either, like Campbell's case, we think has been way oversold, and so you can get an attractive valuation with a nice risk-reward upside. Or in a case like Hershey's, where you have a best-in-class retailer that you can get at essentially the same multiple as the peer group. And so, a lot of attractive opportunities, and I think now's a good time to start picking through the wreckage after all these GLP-1 headlines have taken the space down.
But even if the market is overestimating the impact of the obesity drugs on these names, there's still the rising rate problem. And this is a group of bond proxies. And that's been a part of the story, too, hasn't it?
Yeah, so I think one of the things you have to consider, though, alongside rising rates is which companies perform well in an environment with a challenged consumer. In the case of Hershey's, both snacking and salty and kind of confectionery do well in a constrained environment. And additionally, Campbell's is well positioned for a consumer that maybe trades down to cheaper proteins like they offer in their soup. I'm sure you guys have seen the commercials they have on right now with the Kelsey brothers that emphasize kind of the high protein content. And then in addition to that, talking particularly on Campbell's, we looked at the historical valuation, and right now the upside to one standard deviation below their 5-year trading multiple is still roughly 30%, which is where our price target's at. So I think the risk-reward setup is favorable. And for Campbell's case, you get almost a 4% dividend. So we agree with understanding that these guys can trade down with higher interest rates, but at the same time, we just think, the overall pressure on the space is a little bit overdone. And then in Hershey's case, here you have a company that is in 3 categories that have all grown faster than the total store. And so just structurally is positioned to grow faster than kind of the overall packaged food and beverage universe. And so what you're able to do is get a best-in-class operator at an attractive value. Investors are always trying to look for good entry points on great companies. And we just think this is a good opportunity for Hershey to capitalize on that.
Assuming pricing has gone about as far as it can, do these guys grow through organic? I mean, volume inflecting higher, or is it going to be some bolt-on M&A like Campbell's has done recently?
Yeah. So Hershey, I think the M&A optionality is probably limited to the salty snacks business, just given kind of their dominant market share position in confectionery. But still, that's always an option. Obviously, we've seen they've done a fantastic job with Dot's Pretzels, and that's been an incredible acquisition for them that's really boosted their salty snacks portfolio. And look, with Campbell, I mean, we covered Sovos Brands previously before the acquisition. We think it's an excellent acquisition for the company. Rao's, the spaghetti sauce brand that Sovos owns, that's kind of the growth engine, is really well positioned with consumers. And now it gives Campbell the ability to have, a kind of a mid-opening price point option with their existing portfolio and a premium option as well. And when you look at premium brands and how they've performed, Rao's, despite kind of the overall backdrop, has still done exceptionally well. And I think, tying back to what we mentioned earlier, food can represent an affordable luxury. And so if a consumers identify a brand as having high quality and really a unique flavor profile, it makes it all the more attractive to them. And so we think, Campbell's adding to that to their portfolio is a big win.